Hello everyone. The month of Feb gone by was quite tumultuous as far as the bond markets were concerned. The idiom beware of the Ides of March actually held true for bond markets in the month of Feb, where we saw across the yield curve sell off ranging from lower end of 30 basis points to upper end of 50 basis points. What really caused this trigger? Well, a couple of things. Started off with the budget day announcement of a higher than expected borrowing program because of a higher than expected fiscal deficit. Well, that was lingering on. Even the MPC decision to remain status quo and maintain an accommodative stance on interest rates did not really give much of comfort to the bond markets. Along the month, we actually saw crude oil prices rise up. In fact, year to date, we have seen more than 25% spike in crude oil prices, which again led to fear psychosis in the bond markets. And the final nail in the coffin was the US Treasury auction. There was a 7-year Treasury auction where the bid cover ratio, which is the number of bids received for the amount of auction, was the lowest ever that we saw in the last 11 years. That, coupled with the fact that there was a tepid response to the auction, actually saw US yields rise. In fact, they were already rising quite some time back, starting January itself. So a confluence of global factors and domestic factors included led to spike in bond yields in India. And as I mentioned, even the short end of the curve was not really spared. The fact of the matter remains that the banking system liquidity still continues to be comfortable at about INR 8 trillion rupees or 8 lakh crores. The Reserve Bank of India governor has categorically stated, this is to quote media bites, that they have absolutely no intention to remove the accommodative bias. They seem very clear that the surplus liquidity in the system will continue. Yes, there is a normalization process underway, but that's not likely to be disruptive in manner. Did RBI walk the talk? So far, we have seen continued open market bond purchases, stroke operation twist, where the Reserve Bank of India buys long government bonds and they actually supply or sell short government bonds with an intent to support the long end of the yield curve and also reduce the steepening of the current yield curve. It is therefore very important to see this act continue well into FY 2022, starting April 21, because there is no doubt that the pace of supply is going to accentuate starting April 2021. It is no surprise, therefore, that the bond markets continue to trade in a groove. There are 2 points which I want to leave you with. One is, are you expecting rate hike in the immediate future? When I say immediate future, is it in the next 2 months, 3 months, 5 months, 6 months? If the answer for it is no, it is time for all fixed income investors to continue to remain invested, to enjoy potential carry. The last month activities have further inched up the yield curve, where the overall portfolio YTMs upwards of liquid. So if you see the gap between a liquid category and an ultra short term or a low duration category, the YTM differential is anywhere north of 50 to 100 basis points. If you go into the next category, which is short term category, the gap between a short term portfolio yield at around 2-year duration vis-a-vis a liquid fund yield is almost 2%. And these are all high grade portfolios that I'm talking about. So therefore, it is imperative that investors should happy to be withstanding volatility, look at investment horizons in sync with the typical tenors of the portfolio, that average maturities that are being run, which means if you have a 1-year investment horizon and if you try to get an entry into strategies like low duration fund, which has a 1-year duration cap, these are the kind of strategies which we believe should be the way going forward. Volatility is here to stay, but it is imperative that if we stay the intended investment tenor, And again, I would reiterate, you cannot be coming into a fixed income scheme for 3 years and get disturbed looking at 1 month NAV volatility. Yes, it is important for you to track, but please don't get carried away, because ultimately we are talking about an extended pause, and in an extended pause, there will be palpitations, there will be volatility, yields will move range bound. Ranges could gradually inch upward, but the word here is gradual. And as money managers, there is agility and active fund management to ensure that these volatilities are played into the benefit of the portfolio. So as I said, please keep your asset allocation between equities and fixed income. Keep doing course corrections as and when it is required, but a reaction to a market event and a premature exit certainly is not called for, whether it is fixed income or equities. Foreign portfolio investors continue to be net sellers on the Indian fixed income side. That's not really spooking the markets as much as is the global bond yields, specifically the US bond yields, which had crossed 1.5% for a brief while. It is important to see the market stabilize here, and the next few quarters, I think the way the Reserve Bank of India decides to intervene in the bond markets would be the guiding factor for the next directional move in fixed income. We rule out an immediate rate hike on the repo front. However, post July August, there could be a reasonable chance of seeing gradual upward revision to the reverse repo rate. But again, as I mentioned, nothing is likely to happen in an abrupt manner. Keep an eye on crude oil prices, because that could directly impact inflation. For now, it does not seem to be very threatening. On a last note, it is very, very important that there are two ways to participate in fixed income. One is the duration play and one is the credit play. For those who seek very moderate exposure to credit and very low duration exposure, there are strategies in fixed income to suit that palette as well. So please engage with your advisor if you really need to navigate this maze. That could be a very credible way to go moving forward. Thank you so much. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.